And in our top business story, Etihad Airways has strongly denied that it received $2.6 billion in state subsidies, refuting new figures revealed by US airline lobby group. The Partnership for Open and Fair Skies on Tuesday issued a statement and supporting document from Etihad's non-public financial statements obtained in Hong Kong that show that the Abu Dhabi airline received a cash injection of $2.6 billion in 2014. The lobby group, which is led by the three biggest US carriers, American Airlines, Delta Airlines and United Airlines, along with several unions, said the funds were never disclosed to the US government. However, in a statement to the media, an Etihad spokesperson stated that we have never made any secret of the fact that we have received equity capital and loans from our shareholder. That is completely normal for any business which has significant long-term capital commitments. The official added that Etihad Airways accounts are audited by KPMG and are fully compliant with international financial reporting standards, and that the issues raised have all been addressed in the airline's submission to the US government under the Open Skies docket. Etihad Airways achieved its strongest financial results to date in 2014, posting a net profit of $73 million on total revenues of $7.6 billion, up 52.1% and 26.7% respectively over the previous year. Dubai's tighter property rules aimed at preventing a housing bubble are the main cause of a slowdown in the Emirates real estate sector, as according to industry experts, rather than a sustained drop in oil prices. According to credit agency Moody's, Dubai has a low reliance on oil, despite hydrocarbons providing 3/4 of the UAE's consolidated revenue in 2014. In a local report, property consultancy firm CBRE Middle East stated that while Dubai residential property sales have declined over the past 3/4, the drop in oil prices is coincidental and the slowdown is more due to big price increases in 2013, with the market now adjusting to a return to affordable levels. It was added that this is a positive trend and will help prevent a bigger correction in the future. While housing prices are expected to drift lower this year, experts added that well-balanced supply and demand for properties should keep prices stable. Another consultancy firm, Cluttons, estimates that the house prices in Dubai rose 51% during 2013, before growth slowed to 3.4% in 2014. Last year, Dubai doubled property registration fees and the UAE federal government raised the minimum mortgage deposits, dampening demand in order to better manage extreme fluctuations in the property market and to discourage the practice of property flipping. Telecom operator Du has announced that it recently signed leading global information technology company Hewlett-Packard HP as a new enterprise customer. As part of a multi-level agreement, Du will provide HP employees in the UAE with mobile and fixed-line services, including data. According to a company press release, by providing HP with tailored services, Du will enable its new enterprise client to meet its communications needs, thereby boosting productivity and connectivity. Representatives from HP were quoted in the Du statement as saying that the migration was managed smoothly and within the agreed time frame. Noor Hospitals Group's first-half earnings dipped on higher depreciation costs despite an increase in revenue. The Abu Dhabi-based company posted an 8.5% rise in revenue to $244 million from $224.8 million from the same period last year. That was thanks to a 13% rise in outpatient volumes and a 7% increase in inpatient numbers. The London-listed group also highlighted that increasing revenue contribution from its Al Madar Medical Centre network subsidiary acquired in 2013. The company stated that underlying net profit slid to $44.9 million from $45.4 million last year due to higher depreciation costs arising from the company's focused plan of investment in growth initiatives. Additionally, Al Noor announced an interim dividend of 4.1 pence a share, up from 3.7 pence last year.